I want to read this story to you, and News 12 couldn't even be bothered to do a video of it, but a friend of mine sent me a link to this story, which they didn't even do a story on it as far as a video. They don't have a video. This is just really a regurgitation of a story done by the Associated Press, confirming what we already know about racism. And this is why I can't stand people in real estate, finance professionals, because unfortunately a lot of them, racism is ingrained in the culture of their business. So this is called the secret bias hidden in mortgage approval algorithms. Holding 17 different factors steady in a complex statistical analysis of more than 2 million conventional mortgage applications for home purchases, we found that lenders were 40% more likely to turn down Latino applicants for loans, 50% more likely to deny Asian Pacific Islander applicants, and 70% more likely to deny Native American applicants similar white applicants. And lenders were 80% more likely to reject black applicants than similar white applicants. And these are national rates. So again, the racism pandemic, so to speak, it's almost like a pandemic, and the whole different kind of pandemic. It is across the whole country. However, it is magnified here on Long Island. I do think it is. In every case, the prospective borrowers of color looked almost exactly the same on paper as the white applicants, except for their race. The industry had criticized previous similar analysis for not including financial factors they said would explain disparities in lending rates, but were not public at the time. Debts as a percentage of income, how much of the property's assessed worth the person is asking to borrow, and the applicant's credit score. The first two are now public in the Home Mortgage Disclosure Act data. Including these financial data points in our analysis not only failed to eliminate racial disparities in loan denials, it highlighted new devastating ones. We found that lenders gave fewer loans to black applicants than white applicants, even when their incomes were high, $100,000 a year or more, and had the same debt ratios. In fact, high-earning black applicants with less debt were rejected more often than high-earning white applicants who have more debt. Lenders used to tell us it's because you don't have the lending profiles. The ethno-racial differences would go away if you had them, said Jose Loya, assistant professor of urban planning at UCLA, who has studied public mortgage data extensively and reviewed our methodology. Your work shows that's not true. We sent our complete analysis to industry representatives, the American Bankers Association, the Mortgage Bankers Association, the Community Home Lenders Association, and the Credit Union National Association. They all criticized it generally, saying the public data is not complete enough to draw conclusions, of course, but did not point to any flaws in our computations. Blair Bernstein, Director of Public Relations for the ABA, acknowledged that our analysis showed disparities, but given the limitations in the public data we use, the numbers are not sufficient on their own to explain why those disparities exist. In written statements, the ABA and MBA criticized the markups analysis for not including credit scores and for focusing on conventional loans only and not including government loans, such as those guaranteed by the Federal Housing Administration and Department of Veterans Affairs. Isolating conventional loans from government loans is common in mortgage research because they are different products with different thresholds for approval and loan terms. Government loans bring people who wouldn't otherwise qualify into the market but tend to be more expensive for the borrower. Even the Federal Reserve and Consumer Financial Protection Bureau, the agency that releases mortgage data, separate conventional and FHA loans in their research on lending disparities. Authors of one academic study out of Northeastern and George Washington University said that they focus on conventional loans only because FHA loans have long been implemented in a manner that promotes segregation. As for credit scores, it was impossible for us to include them in our analysis because the CFPB strips them from public view from HMDA data, in part due to the mortgage industry's lobbying to remove them, citing borrower privacy. When the CFPB first proposed expanding mortgage data collection to include the very data that industry trade groups have told us is vital for doing this type of analysis, credit scores, debt-to-income ratio, and loan-to-value ratio, those same groups objected. They didn't want the government to even collect the data, let alone make it public. They cited the risk of a cyber attack, which could reveal borrowers' private information. These new data fields include confidential financial data, several large trade groups wrote in a letter to the CFPB including the ABA and MBA. Consequently, if this data are inadvertently or knowingly released to the public, the harm associated with re-identification would be even greater. Government regulators do have access to credit scores. The CFPB analyzed 2019 HMDA data and found that accounting for credit scores does not eliminate lending disparities for people of color. In addition to finding disparities in loan denials nationally, we examined cities and towns across the country individually and found disparities in 89 metropolitan areas spanning every region of the country. In Charlotte, where Crystal Mary and her family searched for a home, lenders were 50% more likely to deny loans to black applicants than to white ones with similar financial profiles. In other places, the gap was even larger. Black applicants in Chicago were 150% more likely to be denied by financial institutions than similar white applicants were. Lenders were more than 200% more likely to reject Latino applicants than white applicants in Waco, Texas, and to reject Asian and Pacific Islander applicants than white ones in Port St. Lucie, Florida. And Native American applicants in Minneapolis were 100% more likely to be denied by financial institutions than similar white applicants there. It's something we have a very painful history with, said Alderman Matt Martin, who represents Chicago's 47th Ward. And he talks about redlining, a phrase that I like to use a lot. It is the now outlawed, supposedly outlawed, but it's still happening. It's still happening. You see what's going on in the middle of the island. Redlining, the now outlawed practice of branding certain black and immigrant neighborhoods too risky for financial investments that began in the 1930s, can be traced back to Chicago. Chicago activists exposed that banks were still redlining in the 1970s, leading to the establishment of the Home Mortgage Disclosure Act, the law mandating the collection of data used for this story. However, as you see here on Long Island, redlining is still going on. Everybody's denying. They think it's not happening, but it is happening. Why are the roads on the South Shore smooth as butter? Why are their train stations beautiful? Why do they have no homeless people? Why are the towns getting all these new restaurants while middle of the island towns that have more diversity are seeing neglected roads, old poles, train stations that are neglected, homeless everywhere, and abandoned businesses? Why is that? That is redlining. It is still happening. When you see that maybe the tactics are different now, but the outcomes are substantially similar, Martin added, it's not something we can continue to tolerate. Who makes these loan decisions? Officially, lending officers at each institution. In reality, software, most of it mandated by a pair of quasi-governmental agencies. Freddie Mac and Fannie Mae were founded by the federal government to spur home ownership and now buy about half of all mortgages in America. If they don't approve a loan, the lenders are on their own if the borrower skips out. And that power means Fannie and Freddie essentially set the rules for the industry, starting from the very beginning of the mortgage approval process. Fannie and Freddie require lenders to use a particularly credit scoring algorithm, classic FICO, to determine whether an applicant meets the minimum threshold necessary to even be considered for a conventional mortgage, currently a score of 620. This algorithm was developed from data from the 1990s and is more than 15 years old. It is widely considered detrimental to people of color because it rewards traditional credit to which white Americans have more access. It does not consider, among other things, on-time payments for rent, utilities, and cell phone bills, but will lower people's scores if they get behind on them and are sent to debt collectors. Unlike more recent models, it penalizes people for past medical debt even if it's been paid. This is how structural racism works, said Chi Wu, a staff attorney at the National Consumer Law Center. This is how racism gets embedded in institutions and policies and practices with absolutely no animus at all. Potentially fairer credit models have existed for years. A recent study by VantageScore, a credit model developed by the big three credit bureaus to compete with FICO, established that its model would provide credit to 37 million Americans who have no scores on their FICO models. Almost a third of them would be black or Latino. Yet Fannie and Freddie have resisted a steady stream of plaintive requests since 2014 from advocates that mortgage and housing industries and Congress to update to a newer model. Even the company that created Classic FICO has lobbied for the agencies to adopt a newer version, which it said expands credit to more people. A lot of things that minorities and underserved borrowers are doing, responsible financial behaviors, are going under the radar, said Scott Olson, Executive Director of CHLA, a trade group representing small and mid-sized independent mortgage lenders. Fannie and Freddie's regulator and Conservator, the Federal Housing Finance Agency continues to allow companies to stick with classic FICO more than 5 years after ordering them to study the effects of switching to something newer. The FHFA has also expressed concern about the cost of operational implications if they would have to continually test new credit scoring methods. Neither of the companies would answer questions from the markup about why they still require classic FICO. They've been testing alternative scores for years, and I don't know why the process is taking so long, said Lisa Rice, President and CEO of the National Fair Housing Alliance, a consortium of hundreds of fair housing organizations. Well-deserving consumers are being left behind. Fannie and Freddie's approval process also includes other mysterious algorithms, automated underwriting software programs that they first launched in 1995. Too much fanfare about their speed, ease, and most important, fairness. Using a database as opposed to human judgment can avoid influences by other forces, such as discrimination against minority individuals and redlining. Peter Maselli, then a president of Freddie Mac, told the New York Times when it launched its software called Loan Product Advisor. A bank executive told Congress that year the new systems were explicitly and implicitly colorblind, since they did not consider a person's race at all in their evaluations. But like similar promises that algorithms would make colorblind decisions in criminal risk assessment and healthcare, research shows that some of the factors Fannie and Freddie say their software programs consider affect people differently depending on their race or ethnicity. These include, in addition to credit histories, the prospective borrower's assets, employment status, debts, and the size of the loan relative to the property of they're hoping to buy. The quality of the data that you're putting into the underwriting algorithm is critical, said Araceli Panamino, Director of Latino Affairs for the Center for Responsible Lending. If the data that you're putting in is based on historical discrimination, then you're basically cementing the discrimination at the other end. Yeah, exactly. Research has shown that payday loan sellers usually place branches in neighborhoods populated mainly by people of color, where bank branches are less common. As a result, residents are more likely to use these predatory services to borrow money. This creates a lopsided, incomplete credit histories because banks report both good and bad financial behavior to credit bureaus, while payday loan services only report missed payments. Gig workers who are people of color are more likely to report those jobs are the primary source of income rather than a side hustle they're using for extra cash than white gig workers. Having multiple sources of income or unconventional employment can complicate the verification process for a mortgage, such as Crystal Marie and Askeus McDaniels learned. This is a very long article. We're not even through half of this thing. So you can read I'll give you the link, the rest. I don't really want to make this a really long video, but they really should have done a story on this for sure. There is no video, but you can read the rest of it later. You can read the rest of it in the link below about what's going on here. As you see, it's just more discrimination and racism, and it's all amplified here on Long Island. You know, if you're somebody of color, even if you have money, if you go into an area like an enclave on the South Shore and try to get a house, you're probably going to be denied just because of your race. You know, even though you have the money. That's what's going on. There's tremendous racism in banks and real estate, and this article just pretty much confirms what we already know. Thanks for watching.